All right, looks like the participation starting to level off a little bit. So we'll go ahead and kick things off as we await other attendees coming into the webinar. But again, welcome to today's Opportunity Zones webinar, part of our OZ webinar series. Today, we will be talking about OZ strategies that support early stage businesses. And we're really excited to have two guest speakers with us today from Generator, Troy Vossler and Vanessa Huerta. And so we'll kick off a discussion with them in just a few minutes after we go through some Opportunity Zones updates. But wanted to just also note at the top here that we are recording this webinar. We will be circulating a recording of this as well as a recap of our discussion and the slides shortly after today's presentation. And that will be emailed around to everyone who registered when that goes live. So look out for that shortly. If you would like to participate in the Q&A portion, which we will have towards the end after the presentation, please feel free to input your questions into the Q&A box. It's a little easier for us to track that versus the chat. So please, again, use the Q&A functionality so that we can make sure to track your questions there and answer them in the moderated Q&A portion following the presentations. So as I mentioned, we'll start off today's webinar with some Opportunity Zones updates and resources, talk a little bit about the landscape and kind of set the stage for the discussion and presentation from Generator about Opportunity Zone investments in operating businesses. And then we'll talk about scaling investments in early stage businesses and hear from Generator about how they are doing that across the country and specifically in Colorado as well with their accelerator program there. And so we'll talk about capacity building and investor networking for businesses, potential impact of the legislative proposals, and identifying and investing in early stage companies. Go to the next slide. So in terms of updates and resources, we really the kind of the top news in Opportunity Zones lately is the introduction of the Opportunity Zones Transparency Extension and Improvement Act. Earlier this month, on April 7th, Senators Booker and Scott led a group of bipartisan senators, including Mark Warner from Virginia, Van Hollen from Maryland, and Todd Young from Indiana. On the House side, this was introduced by longtime champions, Representatives Ron Kind from Wisconsin and Mike Kelly from Erie, Pennsylvania. And they were joined by Representatives Kildee, Sewell, and Wolarski. So a really great group of 10 co-sponsors, bipartisan, bicameral. And this legislation would make some kind of thoughtful improvements to the policy. I believe Rachel will be kind of putting in the chat links to everything as we're going through each of these resources, but there is a one-page bill summary of the legislation, as well as a section by section summary if you want to get into a little bit more detail. And if you want to go really in the weeds, the full bill text is also available. The congressional press release includes quotes from the leading co-sponsors. And then EIG put out a press release as well, applauding this bipartisan effort. We were really pleased to see the package come together. I think it includes some really important improvements to the policy that will strengthen it, including the establishment of reporting requirements. I think that's been a top priority in Congress and of external stakeholders in the market really since the inception of the policy. But it would extend the policy by 2 years from the end of 2026 to the end of 2028. We'll talk a little bit more about this in our discussions in terms of how this might impact investing in operating businesses, but it would create a fund of funds structure. It would also establish a state and community dynamism fund that would provide some assistance for states and communities to stand up technical assistance programs, capacity building programs, invest in high impact projects, things like that. So we'll talk certainly about the latter two of those provisions more as we get into the heart of the discussion here. So overall, I think a really good package that would strengthen the policy if passed. We also did a webinar on this, so if you want to hear us talk a little bit more about it, we posted that on our website recently. It is the analysis, our webinar on the analysis of the new legislation. So Rachel just put that link in the chat as well. So if you'd like to watch that webinar, that's up on the website as well. Rachel, I'm sorry, I'm making your job harder because I am bouncing around here in terms of the resources. So I'm sorry about that. Kind of more evergreen resources include some of our fact sheets. So the investment activity, proposed legislative improvements, which I think you'll see some parallels between what was introduced, which again, we were really pleased to see that the package is, I think, generally supported by a wide group of stakeholders who have called on some of these improvements for quite some time, and the socioeconomic characteristics of OZ communities. And finally, to sort of complete my bouncing back and forth on this slide, one last resource for you all. We also published the recap and slides from our previous webinar on leveraging opportunities on investments to create affordable homes. That was earlier in the month, kind of pre-introduction, and then we had the legislation webinar on the legislation shortly thereafter. So it's been a busy month of really, really fantastic conversations around opportunity zones, and excited to continue it with this one. So with that, I'll turn it over to Rachel, who will kind of give us the lay of the land as it currently stands with OZ investments into operating businesses.
Yeah, thanks, Catherine. And thanks for keeping me honest about being at my computer, ready to respond to your jumping around. No, very, very easy. So as probably a lot of folks who are on the webinar know, real estate and operating business are both eligible investment activities. However, investment volume has really skewed towards the real estate side of it for a number of reasons, and we'll go over those shortly. But I found it really interesting that a recent survey that was conducted by JTC Americas and Opportunity DB found that upwards of 60% of OZ stakeholders believe that investments in operating businesses will yield a high impact or will be the most beneficial for opportunity zones. So I think it's an indicator of folks understanding where the value proposition is in making these investments. And we also know that there's been a lot of interest in making investments into operating businesses. So as we see, the intent and the interest there, the question is, what does activity actually look like? And we can go to the next slide. So this was recent data from Novogradac. We also shared this on a webinar, I believe, in March. But as you can see, transaction volume into real estate has surpassed exponentially the amount of money going into operating businesses. It represents just a small share of total volume. And so, the question again here is, if there's so much interest and there's intent to make these investments, why is it not playing out in the way that we would hope, or why aren't we seeing more investments into operating businesses? And then in the chat, just to respond to a question, I have links for you both to the survey and the Novogradac report. So you have that. We can go to the next slide. So we do know of a number of opportunity funds that are making investments into operating businesses. This is not comprehensive of the total market, but just some examples to show you that there are dedicated stakeholders that are thinking through this and completing successful transactions. So want to mention Corey Innovation Fund, who we've had on webinars before. They are really making investments into emerging technology companies that are solving societal and environmental challenges. And these companies are largely located in rural communities, but definitely not located in major metros. So really outside of major metros. Verte OZ Fund is doing a great job. The Pearl Fund, Arcturus Impact Investors. There's a quote here on the side from a business owner that received an investment from Arcturus, just so you all can read through that at your leisure. And then Hall Ventures, which they have an incubator accelerator out in Provo. They're also making investments through their family office. Revive Qualified Opportunity Zone Fund, and then Puerto Rico Opportunity Zone Fund, which is a Puerto Rico-based fund that is focused. They're a multi-asset, multi-sector fund, but they've successfully made 2 investments into Puerto Rico businesses. One is an aquaponic farming business, and the other is a sustainable energy company there on the island. So those are just some examples, just to say it is possible. It is happening. It's possible. People have figured out the structure. They figured out how to make it work for their business model. But if we go to the next slide, you can see that there are some known regulatory barriers to scaling this activity. You know, EIG put together a really good letter alongside its OZ coalition on recommendations for legislative and regulatory modifications to opportunity zones that would help to increase investments into operating businesses. This letter identifies sort of 3 main areas that have been identified as hurdles or barriers. Number 1 is the direct investment requirement, which says that an opportunity fund can't invest in another opportunity fund. So this is what, you know, we call a fund-to-fund structure that is currently not allowed. Then there's the pre-existing business requirement, which is basically saying that OZ business property had to be acquired after December 31st, 2017, and used for substantially all of the entity's holding period. And then that becomes a barrier if folks want to make investments into existing businesses in these communities. And then interim gains rule just says that the gains realized on a sale of investment in a QOF that has been held for less than 10 years is not excluded from gross income. And what that says is basically there is a, the way that you make investments and the time period for traditional exits out of these businesses is very different than real estate. And so with shorter exit windows, that the interim gains rule just may be a barrier to putting together funds for investments in operating businesses. So I'll also put that link, the recommendations link that EIG put together in the chat, so you guys can read through that for more information. We are excited that these 2 legislative proposals that Catherine mentioned may unlock some investment capital for businesses. So the legislation would allow for fund-to-fund structure. So that would help to get small dollar equity investments into businesses. It's more rigorous to have to do small dollar investments out of a larger fund. But if you can tranche it in fund-to-funds structure, then maybe that capital would be more readily available in smaller amounts. And then also, I'm really excited about this $1 billion state and local dynamism fund, which can be used for technical assistance and capacity building. We've seen the state of Colorado invest in capacity building and technical assistance through a program that Troy and Vanessa are going to talk about, but specifically dedicated to business readiness and networking with investors for Colorado small businesses. So I think that if this state and local dynamism fund is enacted and funded, the model that Troy and Vanessa will talk about could be replicated in other states and really help to get businesses ready for OZ investment and connected to the right investors. So we can go to the next slide. And with that, I will turn it over to Troy and Vanessa to talk about the great work that they're doing.
Cool. Thank you. Thank you, Rachel. Good afternoon, everyone. My name is Troy Vossler. I'm one of the co-founders of Generator. I'm joined with Vanessa. Vanessa is our director of our G-Beta Opportunity Zone Accelerator program in Colorado, and she's going to be speaking about that. So maybe if we can go to the next slide. To kick things off, at Generator, we always like to start with our mission. Our mission is to be the best partner for a community to invest in its best and brightest. And we do this via what we call the Generator platform. So on the next slide, we list our 5 product lines. So we started 10 years ago out of Wisconsin, and with a very traditional, what we call investment or equity-based accelerator program. So we have a private venture capital fund. We would recruit startups from around the world to participate in our programs. At the time, we were just in Milwaukee and Madison, Wisconsin, and we would invest cash in exchange for equity into those startups and help them grow. That remains kind of the core of what we do. So that's what we call our investment accelerators on the left. But since then, we've really expanded the generator platform to encompass the other 4 columns. So in addition to our investment accelerators, we operate free accelerator programs. This is like the program that Vanessa will describe under the GBeta brand name. Free meaning there's no cost to the startup, there's no tuition or fees, and there's no exchange of equity. So there's no investment or equity exchanged as a result of that participation. We do a lot of work with corporations. We have a peer-to-peer membership group called the Generator Corporate Innovation Network, specifically focused on corporate venture capital and corporate innovation executives. So we work under contract with more than 50 member corporations across the country. And the idea is to not only help them with the creation of corporate venture funds and corporate innovation departments, but it helps us with our startups. So hopefully we can place our startups for customer vendor relationships, commercial engagements, direct investment, or even M&A activity with those corporations. We host a conference series then called OnRamp, specifically designed to connect corporations, startups, and investors within specific industry verticals. We do those in insurance, healthcare, education and workforce innovation, manufacturing, and agriculture. Our 4th product line is our skills accelerators. Generator Skills is a collaboration between Generator, Microsoft, and LinkedIn. So we actually operate an accelerator program for job seekers. So these could be un or underemployed individuals looking to gain new digital skills. We enroll them in one of the LinkedIn learning modules, and these are based on the 10 most in-demand jobs in America. And then on the back end, pair them with employers in our network for full-time or new or better employment. And then lastly, our creative accelerators, perhaps the most unique element of our work. But the idea was, how can we extend the accelerator model, which in our opinion has been very successful for high tech, high growth businesses with some of our GBeta programming, especially what Vanessa is going to describe. I think it also works with more traditional small businesses. And then we thought it could go even further and work with a different type of entrepreneur, in this case, artists and musicians. And so we operate accelerator programs called Generator Music and Generator Art, where the entrepreneur is the artist, is the musician. So it's all focused on through the lens of business. On the next slide here, we describe our locations. We're fortunate to operate across 35 cities, 16 states, and 3 countries. As you can notice by the lightning bolts indicating a location, we're very focused on secondary markets or emerging markets. We started in both Madison and Milwaukee, Wisconsin. Today, we operate in places like Denver, which Vanessa will talk about, Reno, Nevada, Cincinnati, Ohio, Orlando, Florida, Huntsville, Alabama, Anchorage, Alaska, San Juan, Puerto Rico. So the idea is really focusing on these up and coming or emerging markets, but at the same time stitching them together so that if you're a small business owner or a startup in Minneapolis, we can connect you with mentors in Indianapolis, investors in Silicon Valley, corporate partners in Chicago, and you name it. So really, providing that network approach. On the next slide, we give some of our statistics. So we started 10 years ago. On an annual basis, we run 163 accelerator programs across the country. Total, we've worked with 840 startups. Combined, those startups have gone on to raise more than $1 billion in follow-on funding, and they employ more than 8,300 people. Of those, out of our privately funded venture fund, we've invested in 189 of those companies. And then we also, really focus on our diversity statistics, which I'll touch on shortly. On the next slide, we talk about our performance. So on the fund side, we are a for-profit entity. Even though we have technical assistance programs, we do a fair amount of partnering with state, federal, and local government for our programs. But specifically on our for-profit investment vehicles, we feel really proud of the performance. So we have a 3.35 net TVPI, 23.7 net IRR, 1.19 net DPI, meaning of all the money we've managed and invested, we've already returned, meaning realized gains, 119% of that. So we feel good about our financial performance. On the next slide, we really view our work, whether it's technical assistance or venture capital investment, through the lens of race, place, and gender. So to date, 47% of our startups have a founder of color. 83% of our startups are from outside of the major tech hubs. 33% of our startups have a woman founder, 17% with a woman of color founder. Again, we believe our balance sheets should reflect the demographics of the communities in which we serve. In some of these aspects, we're ahead of those demographics. In others, like gender, we are below that, but we're still an order of magnitude greater than the national averages as it relates to venture capital and startups. Our team is similar. We have 100 on the next slide, 114 full-time employees, 51% women, 35% people of color. This has been a strong strategic advantage for us, meaning if our team is representative of the entrepreneurs that we seek to support, whether that's through technical assistance, accelerator programming, or venture capital investment, we find that that really creates a flywheel effect whereby we're able to support, invest in, and help grow more underrepresented founders through that work. And with that, or one more, on the next slide, we've been fortunate to have some national recognition. We've been named at Fast Companies Magazine of list of most innovative companies, best workplaces for innovators. And there's a group, a bit of academic research called the Seed Accelerator Rankings Project. So Generator has been one of the top 15 ranked accelerators in the country for the last 4 years running. Of note, we're the only accelerator in the top 15 ranking that is not in, Silicon Valley, LA, New York. So again, we take a lot of pride in being able to do that. So with that, I'd love to pass it off to Vanessa to introduce herself and the work that she does with the G-Beta Opportunity Zone Accelerator.
Thank you, Troy. I think it's the first time that I hear you give this presentation, and I was like clapping and super excited. Thank you very much for the invite. And my name is Vanessa Huerta, and I am the director of the G-Beta Opportunity Zone Capital Accelerator Program based in Colorado. As Troy mentioned, G-Beta is our free 7-week accelerator program for early stage companies with local roots. This program specifically, the G-Beta Opportunity Zone program, is a statewide program. So any company that is located within an opportunity zone in Colorado can apply to this program. And it's a partnership between Generator and OEDIT, which is the Office of Economic Development and International Trade. And the goal or the intention of this program is to leverage opportunity zone investment within the state of Colorado. This accelerator program, as you see on the screen, it's free at no cost for the entrepreneur. And the companies can either be located or willing to relocate within an opportunity zone to be eligible to participate within the program. We run 2 cohorts per year, one during the winter and one during the spring. And we're having a local program, but really leveraging a national network. Next slide, please. Throughout the program, throughout the 7 weeks, we do different things that would allow the companies to really take advantage of this program and get value from it. We have different types of programming that we bring that is already tailored and customized, but we also really tailor the type of mentoring that we provide depending on the stage of the company, where they're at and where they want to get. This is all focusing on growth, trying to bring to them that 20% month-over-month growth. We do lunch and learn sessions with keynote speakers. I meet with them twice a week, and we also introduce them to at least 5 different mentors per week. Looking at the demographic that Troy mentioned, and within the Opportunity Zone community, we think that the access to network is very limited. So it's something that we really try to bring during the G-Beta program. Additionally, in week 7, after they went through most of the programming, we have our Investor Week. And it's really that in week 7, they meet and pitch to different investors, which is a mix between opportunity zone investors and traditional other types of investment. We end with a pitch night, which we don't think of it as a graduation, but more like a celebration of them. And they present to an audience of investors, mentors, and community members. Next slide. Well, I think I already went through most of the components of the program. So yeah, let's go to the next slide, please. Oh, sorry, go back one slide. Okay, so we recruited a total of 10 companies this year already. We work with 5 companies from January to March, And we selected our first cohort from more than 40 applications. For our second cohort, we had even more applications, which made it even a more competitive application pool, but we ended up selecting another 5 companies. So this means that by June this year, we have worked with 10 companies already. The way that we recruit for the program is making partnerships with organizations that are local and that can help us promote this program, and that are based not only within the Denver metro area, but within rural areas, such as the Startup Colorado, Energize Colorado, Exponential Impact, and others, including the state of Colorado. Next slide, please. These are the logos of our winter cohort, our inaugural cohort for this program. We had 3 rural companies, which were Alluvia Packraft, Zombies Footwear, and Spindrift Sandboards, and 2 companies based in the Denver metro area. Really, all of these companies got a lot of value out from the program, and were able to meet and pitch to opportunity zone investors that I will name in a few minutes. Next slide, please. These are the logos of our current cohort. This cohort, again, was selected among 50 applicants, and the industries vary from clean tech to a B2B2C marketplace in the outdoor recreation space, and even a company within the food industry. They're going through the second week of the program right now, and it's been a really exciting journey for most of them. Next slide, please. As I mentioned, throughout the program, we introduced the founders to over 30 mentors. Also, they have the opportunity to meet and pitch to investors. And we bring a combination of VC traditional funds and opportunity zone funds. If you look at the screen, you'll see some of the examples of opportunity zone funds that have met with our founders. And we're always looking for more, because it's like Rachel mentioned at the beginning of the call, we're trying to really bring more investment into businesses, and which traditionally lean more towards real estate transactions. I'm gonna name them. So Capstone Investments, the Pearl Fund, which was mentioned earlier, Pioneer Fund, Greater Colorado Venture Fund, which those 3 are local, and the other 2 are national. Next slide, please. Next, yes. So basically, I wanted to bring to the attention the partnership and the great partnership that we have with OEDIT. Really, the reason why OEDIT came to Generator is because they have interest to bring opportunity zone investment to businesses within the state of Colorado. Most of the investment in the state regarding OCs has been made in real estate, but they have been successful in bringing some OC investment to businesses in Colorado. At the end of the day, if businesses in the OC opportunity zones receive investment and grow, they will create wealth and jobs within the opportunity zones, which is historically, they've been mostly disadvantaged communities. It is really important to partner accelerators that are working with local companies to find these opportunities to invest. And as part of our group, we work with GAN, which is the Global Accelerator Network, and they really work with us in identifying these accelerators that can work within your market. Next slide. Oh, cool. It's Troy, you're next. Thank you.
I'll jump in here, and then I see the questions coming. So we got 3 more slides, and then we can jump to the Q&A. Rachel and the team asked us to speak a little bit about some of these legislative changes that were addressed. So next slide. We did want to call out 2 of them. So first, the State and Community Dynamism Fund. So $1 billion being allocated to states to support these technical assistance endeavors. What Vanessa just described is an example of that. So I don't believe it was funded by the Dynamism Fund, as that's a very new development, but it's in the spirit of that, meaning if we're expecting these opportunity zone funds to be investing into operating businesses and startups, we need to make sure that we have a mechanism of floating those startups to the top so that they can be identified, and then some degree of matchmaking between operating businesses within opportunity zones, as well as OZ funds that are investing into them. So we think technical assistance is paramount. The better we can source startups, the better we can help businesses develop, frankly, just better results. And certainly that's the spirit of the opportunity zone legislation and program. Next slide, we talk about the fund to fund. So I think this is really important. So the nature of a lot of these operating businesses within the opportunity zones, in many cases, almost by definition, meaning these are underdeveloped areas, and therefore the businesses within them will tend to be underdeveloped. We think that there is a challenge to shove a ton of money into those businesses. And so that implies that the investments are going to be smaller in nature, and they're going to take more time to develop for startups to then raise larger and larger dollar amounts as they continue to scale and continue to grow. One of these issues is that because it's smaller dollar amounts, that predicates typically smaller funds, and the smaller the fund, the harder it is to raise money from limited partners. I should say institutional limited partners. So if I'm talking to state pension funds or corporations, university endowments, large nonprofit foundations, it's difficult for them typically to write checks less than $5 million on the low end. And typically they will also have requirements that they can't comprise more than 20% of a fund. And so again, this just means that by definition, funds have to be, rather large. So it'd be very difficult for an emerging fund manager, in particular, diverse and emerging fund managers who, let's say, want to raise a $10 million fund. It's difficult for them to tap those institutional investors. I think that a fund of funds, the next slide, I think the fund of funds could be a really good example to support this. We launched a fund of funds recently in the state of Minnesota, specifically where dollar for dollar will be invested into Black, Brown, and women-led startups in the state of Minnesota. We already have Allianz Life Insurance, Excel Energy, and Alina Healthcare committed as institutional investors, as limited partners. This fund of funds will then invest into underlying venture capital funds. So this is just an illustrative example that Generator is a partner on, where I think it's important and impactful. Again, if we expect to support smaller fund sizes, which have an outsized amount of emerging fund managers and diverse fund managers, we really need, I think, the fund of funds mechanism to support that. So we are keen to that development. And that's all we have. So maybe we can hop into some of these questions.
Yeah, there are quite a few. So I have some questions, but I want to get to the ones that have been submitted. So just coming here from the bottom, do you have plans to take G Beta national or state by state? So what is the current footprint of the G Beta program, and do you have expansion plans?
Yeah, so G Beta is our largest product line, but in terms of number of programs and headcount, with G Beta alone, we're in over 30 markets across the United States. Most of those are specific to local companies, but they're separated from opportunity zones. So they really have nothing to do with opportunity zones. They were really designed to be a pre-accelerator program, kind of a farm league version of our Generator investment accelerator, but captive and exclusive to local startups. So for example, in Cheyenne, Wyoming, our G Beta program is sponsored by Microsoft, who's just looking to support community development. In Minneapolis, St. Paul, we have a G Beta program focused on medical devices, sponsored by Boston Scientific, BARDA at Health and Human Services, Mayo Clinic, the University of Minnesota, and University Enterprise Labs. Yet another example is in the state of Indiana. We have a partnership with the Indiana Economic Development Corporation, where we operate 6 different G Beta programs. Some are around industry clusters that the state of Indiana has developed, like 5G technology, autonomous vehicles, and energy and sustainability. Others are community focused in cities like Fort Wayne, Terre Haute, Indianapolis, etc. So that's G Beta. Again, it's broader than just opportunity zones. In Colorado, however, that was the first endeavor where we partnered with the state of Colorado, who specifically was looking for an operator, a vendor, to run an accelerator program for operating businesses that are reside in opportunity zones. And so this is the first and to date only version of our accelerator program that is captive and exclusive to opportunity zone operating businesses. If there's interest from, whether they're state government or the private sector, and extending that model more broadly to other states, other communities, or nationwide, we'd certainly be very interested in that.
Yeah, I'd highly recommend folks, if you're interested in learning more about the G-Beta program or what is happening in Colorado, to reach out to Generator. And even I would imagine that the G-Beta programs that you guys are running in other places, even though it's not exclusive to opportunity zones, there may be some eligible businesses that are coming through those programs. And so if folks are looking to source pipeline, perhaps there could be some screening that they could do alongside you all to identify those businesses.
I agree. We'd love that.
Cool. We'll reach out to Troy and Vanessa. So I guess I also had a question similar to that right here, just because as investors are thinking through how they may want to engage, folks are asking, are the funds primarily looking for all caps venture capital return? So there's been a lot of discussion with opportunity zones around target return, target IRR, et cetera, and what the market is demanding by way of that. So just curious about the funds that you're working with, what they're looking for as far as returns.
Yeah, good question. I mean, so to clarify, the funds that Generator manages are not opportunity zone funds, and so they're not captive and exclusive to opportunity zones. And so when I shared our performance, et cetera, our funds with private limited partners, we are seeking venture capital returns, and we're investing into startups that we think can produce those venture capital returns. And that's agnostic of whether or not that business is in an opportunity zone or not. With the program that Vanessa runs, just to be super clear, we are not investing into those startups, but we are serving as a facilitator to help not only identify, source, and kind of grow and mentor those companies, advise them to kind of go from point A to point B, but then we're trying to facilitate follow-on investment. So, Vanessa has partnered with a number of opportunity zone funds who participate in what's called the investor swarm. So they sit in and they get to watch each of the 5 startups at a time in kind of a quick pitch networking opportunity, with the concerted goal that can lead to some real investment on a follow-on basis. But Vanessa, I don't know if you have anything to add. When you talk to those funds, do you get a sense for what type of returns they're looking for? And is it different than a traditional venture capitalist?
Yeah, no, I think that the feedback that we've got from the investors is that they are always, looking to find these deals, but most likely some of the restraints or the constraints is the 10-year period, making sure that they can take the incentives. So I think that the questions have been more towards the exit strategy for the businesses rather than the returns.
Yep, that makes total sense. Let me see. Just running through these questions. Well, while I'm looking through these, Troy, one of the things that you had mentioned is that technical assistance is paramount. And so I was just hoping you could underscore what you all mentioned as far as the type of technical assistance these businesses are needing. When they come in the front door, what do they need in order to be investment ready, or at least begin those conversations with investors?
Yeah, I think a lot of it is 90% of the businesses that we work with through any of our programs, they've never raised angel investment, much less venture capital. So they're doing it for the first time. And I think it's you have to learn by doing it. So you can read all the books or read all the blog posts and listen to all the podcasts, but until you're actually going through that process and you have a coach, someone like Vanessa in your corner, who's training you up to that point to make a pitch and then walking you through kind of some of the mechanics and whether it's helping you negotiate or identifying other potential investors. So really our technical assistance starts with everything from helping a company get incorporated if they haven't been formed yet, helping a company think through other legal issues, whether that's employment practices, working with contractors, depending on the business model, et cetera. But then raising money. So at the end of the day, the businesses that we work with, for the most part, are going to have to raise some sort of additional external capital, whether that's loan, bank financing, venture capital, angel investment. They're going to need that to continue to grow and execute on their vision. And so a lot of what we do is educating them around best practices, putting together everything from a pitch deck to perhaps a data room that they would end up sharing with investors, practicing that with them, and then actually, holding their hand and scheduling those pitches. So we're not just letting them run amok, but we're saying, hey, we're actually going to schedule, dozens of pitches to get you in front of potential investors. And then as they do those pitches, our job, we're measured on how can we get companies funded on a follow-on basis. And so it's incumbent on us to advise those companies through the process, whether that's negotiating or, continue to coach them to say like, hey, when they ask this type of question, really what they're asking for is this, and here's how we would suggest answering that question in the future. It's very tactical, things like that. But a significant amount of our technical assistance is predicated around helping companies be ready for and to execute on raising follow-on funding.
Yeah, and I'd imagine, the companies you listed, the opportunity funds you listed, those feel like seasoned funds that are familiar with the opportunity zone space. But I would imagine that you may need to do some technical assistance with the investors as well. It's on the other side, especially as they're thinking through OZ compliance and how to think about investments into an opportunity zone business as far as mitigating risk.
Yeah, Vanessa, do you think of any examples where you talk to more new investors?
Yeah, thank you, Troy. Yes, so with OEDIT, our partner introduced us to an attorney that actually gave a workshop, and that was just very helpful on both ends, and brought just lots of information and really criteria that if you're thinking on investing an opportunity zone business, what you need to do and really what you need to be prepared for. So bringing that session into the program was really beneficial on both ends.
Mm-hmm. Thank you, guys. So there's another question. I'm just going to read it because when I try to interpret things in shorthand, I somehow miss something. So the question is capitalization and fund-to-fund investment. Can you dig deeper into the solutions for attracting investment into communities where projects are less than 5 million, or the businesses can absorb 5 million, so less than 5 million? And are these smaller funds restricted to accredited investors?
Yeah, I'll try to interpret that best I can. With the fund of funds model that the new legislation is allowing for, I think the benefit is, if we look at the top of the funnel with institutional limited partners investing, typically for a variety of good and perhaps superfluous reasons, they can't be more than 20% of a fund. They typically will only want to do $5 million commitments or significantly higher than that as a minimum. And so if you're, if myself or Vanessa wanted to raise a $10 million opportunity zone fund, it would just be really difficult to attract that type of capital into the fund. And it would be difficult to attract just kind of super angel or high net worth individual capital too. So you're kind of in this donut hole of or Goldilocks zone that's difficult to raise for a fund. So the benefit of a fund of funds is now a capital allocators could put in significant more dollars into this top of the funnel, let's call it fund of funds. So let's say that fund of funds is 100 million, 250 million, or on upwards. That fund of funds then could invest piecemeal into 10, 20, 30 other qualifying opportunity zones funds underneath it as the limited partner. So it's kind of a way of creating a degree of separation, and it allows institutional investors and limited partners to invest where they need to invest for administrative and rule-based reasons at the higher dollar amounts, but then they get the benefit of much broader diversification with the fund of funds model. And then in my opinion, the smaller the fund, the easier it is for that fund to do smaller deals. So when we're talking about deploying $250,000, $500,000, $1 million checks into startups and small businesses operating in opportunity zones, that's going to be more akin to a $10 million fund than it is for a $1 billion venture capital fund. So again, I think the fund of funds model really helps open a lot of doors in that regard. As for, will the smaller funds or the underlying funds be restricted to accredited investors? I think that would depend. I don't know the OZ rules related to that, but typically the securities issuer, so the fund manager would decide which SEC exemption they want to raise under. So most of which, or the most common paths, would require accredited investors, but there are paths that allow for non-accredited investors as well.
Yeah, I think, Troy, that was a perfect explanation. And the way that I really see it when you're thinking about the spectrum of investors, you have your institutional investors at the top, the folks that want to deploy in large chunks. And then if you're trying to raise smaller funds, smaller, 5 million and under, where I've seen folks have success is do like a family and friends round where they're just reaching out to their network to raise capital. And in those scenarios, I do think that the SEC allows, as long as you don't raise money from more than a handful of investors, then you don't have to issue a prospectus, and you don't have to go through all of that, public facing security stuff. So that could be one way to handle it. And then, as Troy mentioned, there are ways where if you just wanted to raise in one state, you could blue sky, so you could register with the state as opposed to having to register with the SEC. So those are just sort of the ways that I've seen it happen in the past. Hopefully that answers your question, Gary. So going back to the technical assistance piece, people don't typically think of mentorships as technical assistance, but I'm so glad that you guys offer sort of this mentor matching, because we hear that all the time. A lot of emerging companies, just as much as they need capital, they need mentorship. A lot of them haven't known founders before, and so they don't really have anywhere to go to sort of seek out advice. I'm curious, what are sort of the mentorship needs that you all are seeing with the businesses that come through your accelerators?
Yeah, maybe I can start with a bit of the history on what we call our mentor swarm and the theory behind it. Then perhaps Vanessa can give some more tactical examples of how that plays out. What we call the mentor swarm for any of our accelerators, our investment accelerators, our G-Beta programs, Vanessa's Opportunity Zone program, we host what's called a mentor swarm, where we invite dozens of smart, well-connected people. Those could range from serial entrepreneurs, alumni of our programs, past investors in Generator and G-Beta companies, community stakeholders, corporate partners, kind of you name it. Basically anyone who's willing to raise their hand and volunteer their time to pay it forward a little bit and enjoy the experience of meeting a diverse group of 5 entrepreneurs and startups. Our theory behind that is, if we can connect you as an entrepreneur with as many smart, well-connected people as possible, we think that positive serendipitous outcomes will emerge. And that could be everything from sourcing talent to your company, getting a referral to a potential customer or vendor or strategic partner, that person being an investor or referring you to an investor, or even M&A activity. And we've seen all those permutations play out. So really it's a volume-based game of, let's get as many smart, well-connected people as possible, spinning that roulette wheel, if you will, meeting with these entrepreneurs, and then coaching the entrepreneurs to be pleasantly persistent in following up. So if I'm meeting with Rachel for a 10-minute session and she rattles off, 2 names of individuals and 1 name of a nonprofit that she thinks is applicable to my startup, we want to coach the entrepreneur to make sure that they're following up appropriately and asking for those introductions and following up on those referrals. So that's the theory behind it. And Vanessa, perhaps I'll let you describe on how that plays out tactically.
Thank you, Troy. Well, you said it mainly all, like how me as a director, and I think it's all across the board with G-Beta, we try to bring into that mentor swarm session, which is a 2-hour session with 5 mentors every week, 5 different mentors. I try to make a mix of potentially, if I can get 2 founders, experienced founders that can join the session, and then an investor, and potentially 2 others that have a specific expertise, like let's say digital marketing or in legal. Just bringing those 5 people to the founder, even for 15 to 20 minutes, is very impactful, because they can introduce to other people in their network, share their knowledge, and really they do it as a paid forward, which I think it's amazing, because they want to be there. It's not that we're paying them or we're telling them, we'll do you a favor later. It's really because they care about the ecosystem. And just today, when I was talking to a future mentor for a cohort, he works right now in private equity, but he was in impact fund here in Colorado. And he actually made a lot of research on opportunity zones. So it's like bringing a person that can really have common knowledge in 3 of the main areas that we want them to have mentorship in.
Awesome. Thank you, guys. One of the things that I really like that you guys are doing with the G Beta in Colorado is that you're not only bringing opportunity zone investors or investors that have opportunity funds into the mix, you're bringing other investors, traditional investors that maybe aren't investing for the OZ benefit. And I think that that also reflects on the other side where the businesses that you're bringing through the accelerator, you're teaching them skills and providing them with knowledge that's just going to generally be applicable even outside of opportunity zones. So if they don't get that OZ investment, they still have had those interactions with capital providers. They can carry that forward with them. So that's just my plug. If states are thinking about, or cities or any local government is thinking about doing a similar program, maybe targeted to opportunity zones, just knowing that it's going to strengthen your entrepreneurial ecosystem in general. Not a question, just a statement. But I guess the question is, if states are interested or cities are interested, and you even said, Troy, private companies could partner with you to do these accelerators as well. What should they be thinking about as far as their strategy? And when should they reach out to you? After the program is already baked in their head, or should they be partnering with you guys to co-create a program?
Yeah.
How do you like to do that?
Really, anyway. So I'll start with corporations. When we're working with corporations, it's different in each case. I think the most common example is that corporations are looking to kind of spice up their innovation pipeline. And so they use an accelerator partnership with Generator as a way of getting access to new deal flow, exposing their base of employees to new and innovative ideas in the form of startups. It could be deal flow for their established corporate venture fund or a corporate development team, et cetera. That's kind of the most common, but there's other examples too, where corporations are looking to do some sort of community or economic development initiative. Some of these are tied to real estate projects as well, in full disclosure, meaning, hey, we're building a new mixed use building and we want to activate the space with some sort of innovation or small business programming. And so they contract with us or write us into an RFP for a developer, et cetera. Those are examples with corporations. With states, it's really around economic development and growing the base of business in that state. And so in the case of this Colorado program, we were responding to an RFP that the state had issued. In other cases, it can be more collaborative in terms of us talking to them and designing a program. I'm certainly biased, but we would love to be involved at the earliest stages of talking about how a program can look or be designed, versus sometimes RFPs come out and I wish that they were written a little bit differently, or it's a little bit of a round peg in a square hole that we have to accommodate. Now, certainly there's good reason for that as well, but we're always looking for new RFPs that we can apply to and respond to. But in addition, we'd love to have conversations with states or local government looking to establish technical assistance programs in this capacity. And you can just email me.
Awesome. Well, Catherine, unless we have any questions, we may be able to wrap up about 5 minutes early.
Yeah, I don't see any more coming through the chat or the Q&A, so I think we can go ahead and do that. But thank you both, Troy and Vanessa, for a really great discussion and presentation. We really appreciate you both being here today. And thank you everyone for participating and for really active and engaging kind of Q&A too. That was great. So as we mentioned at the top of the hour, this is being recorded. We will have a recap and recording and slides available shortly after, probably within the next week or so, and we'll email that out to everybody who registered. So you will get that in your inbox as soon as it's live. And I think with that, Rachel, anything else I missed?
No, I mean, I should have thought about it before turning it over to you, Catherine, but if Troy and Vanessa have any sort of closing remarks or ideas, please feel free.
Absolutely.
Yeah, again, thanks to Catherine and Rachel and EIG for inviting us. We think the reforms happening to the Opportunity Zone program are very much in line and needed. And to the extent anyone listening is interested in bringing a technical assistance program to your community, please let us know.
Awesome. Well, thank you all for joining, as Catherine said. And Catherine, now I will officially turn it back over to you to close us out.
No, that's okay. I think I covered everything, but I'm very glad to hear that the proposed, reforms or improvements in the legislation would in fact be impactful toward, gaining more investments in operating businesses. That's been one of, our primary goals organizationally. I think that's always been a goal of the congressional champions of this policy, really from the get-go. So, hopefully, and with everyone's support on this webinar, we can work toward getting that passed and hopefully see, more investments going into operating businesses, because at least in part of some of these changes. So please reach out to Rachel or me if you are interested in learning how you can support the legislation. It'll be an important time over the next few months in showing kind of general support from stakeholders in the market, for some of these improvements. So with that, I will officially close this out and thank everyone once again for attending, and Troy and Vanessa for your presentation. Really appreciate it.
Thank you. I appreciate it.
Bye, everyone.